Have you heard the rumor that all annuities are bad? That they tie up your money indefinitely, that the fees are high, and that if you pass away, the insurance company gets to keep your money? Then stay tuned. Today I'm going to review the facts, the myths, and the pros and cons of the three main types of annuities: fixed, indexed, and variable. So why should you listen to me? Well, I've spent the last decade of my life not only studying finance, but I manage millions of dollars for our clients who are approaching, newly, and in retirement. Every day I help people retire when they want and how they want, and I've reviewed enough annuities to know the difference between a good one and a bad one. Before I get started though, be sure to like and subscribe to our channel. This helps us get this information out to as many people as possible, and we really appreciate it. Okay, let's confirm and dispel these rumors about annuities. Let's begin by reviewing what an annuity actually is, and then we'll move on to the pros and cons of each type. Simply put, an annuity is a contract between you and an insurance company that requires the insurer to either credit your account with a stated interest rate, a potential interest rate based on a stock or an index's performance, or make payments to you, either immediately or in the future. For example, many pensions are simply annuity contracts, where an employer deposits a large lump sum of money with an insurance company that promises to pay its retirees a stated amount of income each month for as long as they live. If you're using non-qualified cash to fund an annuity, your annuity will grow tax deferred. This means that you will not pay income tax on the growth of your contract until you withdraw it as income, similar to a traditional retirement account. Also, each annuity has a term where the majority of your money is tied up for a stated time period. These periods range from 2 years all the way to your lifetime. Though annuities have been available since the 1700s, the contracts that became mainstream in the 1980s had several flaws to the point that they gave themselves a very bad reputation. Many were sold as a bait and switch, and this is what started these rumors in the first place. The client was told that they would not lose money, but because they were invested in a variable annuity and the market went down, they did. They were told that their family would receive a death benefit, but because they invested in a life-only annuity, the insurance company received the remainder funds. The truth is, these products were fraudulently sold and misunderstood, creating a slew of rightfully unsatisfied customers. Fortunately, since the 1980s, these products have improved tenfold, and a few are even worth considering for your portfolio if you are approaching or in retirement. But first, we're going to review one type of annuity that I don't like 99.9% out of 100 times, and this is the variable annuity. Variable annuities are annuity contracts where the value fluctuates based on the performance of an underlying portfolio of sub-accounts, which are essentially mutual funds. Because of this, they offer the potential for higher returns. However, when the mutual funds lose value, so does your variable annuity contract. This on the surface does not bother me. It's no different from taking market risk when you're investing in a mutual fund in a brokerage account or an IRA. However, the fees on most of these contracts are just too high. Typically, a variable annuity has 3 to 4 separate fees per year that can total anywhere from 1 to 4% of the contract's account value. There's an annuity account fee, a mortality expense, an underlying sub-account fees, and sometimes even a rider fee as well. I've reviewed variable annuity contracts for new clients where the fees alone were 3.5% per year, and they wondered why they couldn't make any money. I see the tax argument for a large non-qualified annuity invested with a very low-cost provider just to avoid capital gains and ordinary income tax, but for 99% of people, it makes no sense to tie up money for a higher fee that could lose value in the stock market. If you pass away during the contract, your beneficiaries will receive the full account value penalty-free. So, do these products tie up your money indefinitely? No, they tie it up for the time frame that you chose in your application. Does the remainder balance go to the insurance company upon your death? No, it will go to your beneficiaries. Number 3, are the fees high? Unfortunately, usually, yes. Now, just because I don't like variable annuities doesn't mean that I don't like any annuities. Quite the contrary, actually. Shifting gears, The right fixed annuity can offer many benefits to a retiree. Let's review the three main types. Multi-year guarantee annuities, fixed indexed annuities, and single premium immediate annuities. Multi-year guarantee annuities are my favorite type of annuity, and here's why. They offer a stated, guaranteed interest rate for a certain number of years, my preference being anywhere from 2 to 5 years. They work very similarly to a CD, and that there are no fees on the account. The stated interest rate is your net rate. And just like any annuity, there is a surrender charge if you withdraw all of your money during the stated time frame. However, most of these multi-year guarantee annuities offer free interest withdrawals, which is a fantastic tool for retirees who want to take a guaranteed income stream without touching their principal. Here's a current example. The highest 5-year rate with an A-rated carrier right now is 5.95% per year. So if you invested $100,000 today, you could let the money grow and compound for 5 years and receive a guaranteed $133,507. Or you could take the interest out each year of $5,950 and receive your $100,000 back after the 5-year period. If you pass away during your term, your beneficiaries will receive the entire account value penalty-free. The rates are competitive from 2 to 5 years, and we often build ladders for our clients to hedge against interest rate risk. Multi-year guarantee annuities are an easy and inexpensive way to hedge a stock portfolio in retirement. They only tie up your money for a stated term, your beneficiaries will receive your entire account value penalty-free, and there are no fees on the contract. Okay, my second favorite type of annuity is the fixed indexed annuity. And it's my second favorite because these are more complex. And if you're investing with an insurance agent who is more commission focused than client focused, you can get stuck in one with bad terms. Because remember, you are tying up your money for a certain time frame. In other words, there's a lot more room for error with a fixed indexed annuity. However, our clients are presented with only the best options, and I'll review the best current terms available. Fixed indexed annuities are linked to a market index with a 0% floor, so you cannot lose money to market volatility. However, your performance is either capped, triggered, or participation rated. Let me show you what I mean with my current favorite product. We're going to invest the same $100,000, and this particular annuity gives you a 9.5% annual performance trigger linked to the S&P 500. Let me define that for you in English. Let's say that your money gets invested on January 20th of this year. And this means that if the S&P 500 index returns anything between January 20 of this year and January 20 of next year, even if it's just plus 0.01%, your account will automatically get credited 9.5% for the year. If the S&P 500 loses value over that year, you will earn 0% because that's your floor. Now let's go over a real-life example comparing this fixed indexed annuity to the S&P 500 index. The S&P 500 index is in the left column, the annuity is in the right column. Year 1, the S&P 500 returns 6%. This means that you'll earn 9.5% in the annuity and 6% in the S&P 500 fund. The following year, the S&P 500 returns 16%. So you'll again earn 9.5% in the annuity, but you'll earn 16% in the S&P 500 fund. I've written the account values in the column so that you can compare as we go along here. The third year, the S&P 500 loses 10%, so your annuity earns nothing or stays the same, while your S&P 500 fund loses 10%. The fourth year, the market returns 12%, so you will earn 9.5% in your annuity and 12% in the S&P 500 fund. The fifth and final year of your contract, the market returns 8%, so you will earn 9.5% in your annuity and 8% in your S&P 500 fund. With compound interest, you can see that over this 5-year time frame, your fixed index annuity outperformed the S&P 500. Of course, this is not always the case, but this annuity does allow you to participate in the upside of the market without any of the downside risk. Again, keep in mind, you can only withdraw 10% per year penalty-free. So this is for money that you're not planning on touching beyond that for the 5-year time frame. Some fixed index annuities offer riders for a fee to pay out a guaranteed stream of income on a future date. These can be compared directly to pensions, so shopping around for the best guaranteed income payout is smart. Like the multi-year guarantee annuity, if you pass away during the term, your beneficiaries will receive the entire account value penalty-free. So, fixed index annuities do tie up your money for the stated term, and please do not go out more than 5 to 7 years unless you're purchasing an income rider. Your beneficiaries will receive your entire account value penalty-free, and there are no fees on the contract unless you are purchasing a guaranteed income rider, which can range anywhere from 50 basis points to 2% per year. Before you invest in a fixed index annuity, please make sure that you fully understand the product and trust the advisor that you're working with. The last main type of fixed annuity is called a single premium immediate annuity. These annuities are purchased with a lump sum of money, and the annuity immediately or 1 year in the future begins paying you back your purchase price plus interest in guaranteed installments. For example, let's say that you and your spouse are 70 and 72 years old, and you'd like a stream of income that you can't outlive. If you invested $100,000 today, you would receive $8,000 per year or 8% guaranteed to age 121. These do have a return of premium options now, so if you both pass away early, the remainder funds can go to your heirs instead of the insurance company. When you invest in these, you have to understand that you are kissing that lump sum of money goodbye in exchange for a guaranteed income stream. We like to use these and the fixed index annuities with riders to shop around against employer pensions. First of all, we can usually beat the single or joint income that your employer pension can provide, and second of all, our clients' heirs get whatever's left instead of your previous employer. This is a win-win. Income annuities are tied up for your lifetime, so that rumor is true, but the fees are not high and your beneficiaries will get whatever's left penalty-free. Please keep in mind that fixed annuities are backed by the creditworthiness of the issuing insurance company. It's crucially important to choose a highly rated carrier with a good reputation. If you are approaching newly or in retirement and need help structuring your portfolio for the long term, please reach out via our website or by calling our office. We would love to help. See you next time.